Could this be the most important chart that we could be looking at right now? Hello, ladies and gentlemen, and welcome back to a special weekend edition of the Markets Around the World. We'll be discussing stocks, commodities, and cryptos, and more importantly, looking at the last 2 days of skew crush and the rotation that we've just seen. Non-farm payrolls came in hot. We've got T-bill issuance at a new extreme this week thanks to the debt ceiling. And realistically, we have a whole bunch of options discussion to be had. Did someone just sell a lot of calls? We'll be talking about that later on. Let's get into it as we discuss markets. Well, welcome back, everybody, to the Daily Show where we talk about markets around the world. We've got the news, latest indicators, macro data, and of course, the hottest charts coming your way. If it's your first time here, welcome to the community. Subscribe, smash that like button. I'm sure you're going to find a lot of value in today's video. We've got a big show ahead. So let's discuss the bear market exit. We've seen a move on breadth. Finally, we saw a rotation into a whole bunch of other sectors with the Russell 2000 and others actually starting to break out. But does this mean that we're in a new bull run? Well, of course, it's often considered when you go from the bottom 20% up to the new high of over recovery of 20% gain that you are in a new bull market. Now that's around 4,300 and we've discussed the 4,300, 4,350 possibility for a while. With skew compression at such an extreme though, we're going to need to be ultra cautious around here as this is where everything switches. And of course, usually you see a pullback before you will get a full run, even if you're going into a new bull market, which we'll talk about. Let's discuss the idea of 339,000 jobs being put on. It's hot out there for the US economy, and the Fed probably has more work to do if they're going to get it under control. But the market initially liked it. Unemployment went up to 3.7%, but we also saw some massive revisions. I mean, these joke numbers just get more ridiculous by the month. We can see here March was revised up now 52,000 and April was revised up now 41,000. So from being negatively revised to now positively, it just shows you how ridiculous sometimes these jobs numbers can be. Anyway, let's have a look at change in non-farm payrolls. Basically, we saw here a pretty big switch. Obviously, professional and business services and private education and health services were some of the best, and a lot of jobs got put on as well through the government. So yeah, more of the same, a pretty strong economy in the US. And during normal times, if the Fed wasn't trying to fight that a little bit, you'd say, damn, this looks pretty good. And no wonder certain stocks have been doing well. Now, at the same time, do we finally have some breadth move out? Well, let's have a look at the survey report here coming in for the US markets. What do people think over the next 6 months? Well, we've got the reports here. And for bears, I'm sorry, it's not negative enough yet. You need less bears, more neutrality, and way more bulls. You know, we need these readings. Can you look at a date here? 1 year bullish high. Take a look when it is. 37.5%, week ending February the 8th. So what happened then? Markets fell pretty much a week later. We really do need everybody on board the bull train for markets to be able to fall, but the skew is promising. Let's have a look at the biggest players. Were they actually rotating out? They're neutral still. They're still purchasing with more bullish movement. However, they're mostly neutral. I would say this is kind of like a 60-40 split. If they get $1, they're putting like 60 cents into the market, keeping 40 cents back for some kind of pullback at some point. And it's really still mostly cautious in these markets. If we take a look at the gold runs, you can see here that gold has been getting shorted a little bit more, or at least people are buying less. That's showing up in price action as well, where we've seen gold weaken. If this continues, of course, what do we expect? Gold to continue weakening. We'll be on top of that one. The US dollar, people can't understand it. In recent weeks, we've seen an uptick. We knew as soon as we saw this uptick, along with that giant bullish weekly candle, that we were probably going long. We've hit a resistance, we've dropped down, and in fact, gold and dollar were some of the most predictable markets through the Friday session and also through the last couple of weeks. We've really been on top of those ones the most, I would say, on the channel here. It's been a lot easier than just looking at, you know, runaway AI stocks and then going, okay, well, this is still bullish. Where can we get the close? Where are we going to actually see this sell off, et cetera, et cetera. Remember, there are many markets out there and tons of opportunities. So never feel FOMO. There's always another one coming around. When we take a look at Treasury notes, you'll notice Treasury notes are still in huge demand. So a lot of people are freaked out about this one. We'll talk about it soon. But realistically, Treasury notes still being purchased at an incredible rate here in markets. Although leveraged money is trying to short it, it's an interesting one. Let's have a look at the T-bills here. We've got an upcoming auction That's obviously a big one. Everyone's talking about this on Twitter and everyone's getting wild on it and how scary it's going to be. It depends on your time frame, doesn't it? But you can see here 13-week, 26-week, and 44-day. We've got 65 billion, 58 billion, and 50 billion coming in. A whole bunch of other T-bills coming up. And yeah, I mean, this is expected. I mean, the debt ceiling, etc. We'll have a look at a chart on what's happened historically around debt ceiling hikes with T-bills, because it wasn't negative last time. So will it really be negative this time, even though everyone's, starting to say, oh, it's horrible, it's going to be shocking? Well, we'll have a look at the history. So let's discuss, of course, one of the other sides here, which is, of course, Fed hiking cycles. We know that the Fed doesn't hike for any reason other than to stop or cool the economy. Generally, on the hiking cycle, they cause recessions. And I just wanted to show you here that 11 of the last 14 hiking cycles landed in recession. And you can see here the soft landings versus the recessions. It's only 3 soft landings in very special circumstances. The odds are still not on your side, but we do know that you can't have a recession generally ever before uninversion of the yield curve. We'll talk about that later on. That's where the US 2-year goes underneath the US 10-year again. So instead of being above, it goes underneath. And then the other thing that we need to see is actually the jobs numbers cooling. Did we see that? No. So it's very unlikely at this stage that we're even 6 months away from something like that being called. Let's talk about the most significant spread in history of consumer discretionary. We brought it up on our last video, and we basically said that consumer discretionary was weirdly not coming with the market. It should have been the next rotation. Funnily enough, it had a good Friday. But here's the big movement, and you can see here that equal weighted was terrible in comparison to the mega cap. And the reason why is because the mega cap consumer discretionary, which by the way, I still think has a very good long-term, kind of plan on it for AI. I think it has real initiatives there that AI can make work for them. It's actually looking at, basically 2 or 3 stocks running that whole entire sector, Amazon, Tesla, etc. Discretionary after a 3-month range. So when we get readings like this, you can see that we often get very bullish next couple of periods. Funnily enough, we just saw a very bullish day, and then we get like a kind of lackluster couple of months after that. So are we about to hit some serious peaks on these markets? 4,300, 4,350, big levels, certainly ones to watch. When we're talking about seasonality of pre-election years, you tend to run through June a little bit. Yes, we're in June. You tend to run, especially the NASDAQ, through June into July. Then we get that dreaded Q3 slowdown that tends to come through. Now, in pre-election years with debt ceiling years, they've tended to be worse. So again, if it's more likely to sell somewhere in that July, August, like I've said a few times here, there's a reason I've set for 4 months at 41.50, and it's because, I think September, October, August, they're going to be the months if they're going to happen. Debt ceiling seems to be going through. So at this stage, of course, when the limit is changed, it's usually got a slight negative effect after the fact. It's a buy the rumor, sell the fact, or at least sideways the fact. As we approach 4,300, 4,350, I'd expect us to have a little bit more boost in us, and we'll talk about that now. So first up, the skew. That's a compression. So that's exactly what you're looking for if you're a bear. You want to see the black swan indicator get wrecked for a couple of days, which it has. That's pretty much an activation there. Now what you need is defensives. We need defensive sector rotation. We need to see these sneaky people starting to get into it. And I will say, I was watching the session and it started negative. We'll go through that soon. So skew's been compressed. We've seen skew compression during most of the other sell-offs in the last basically year that were any significance. So we saw one in April, and we obviously saw one in August. They're generally before the fact. So that's something that's interesting. PCC, put call ratio. Look at this, dump to new lows. This is a significant low. So basically calls everywhere. Everyone loves the calls. What would you like to buy today, sir? I'd like a call. Not a put anymore, it's calls. So that's a good thing. And I guess you're looking for that to continue, especially if we start to hit 4,300. And what you're looking for is if it does sell off, then it usually picks up a little bit. During all of that, you don't want an incredible movement directly into puts. So remember, people have been burnt heavily around this year. Obviously, there's a lot of burning of puts. If you look at PutRight, which we've talked about before on the channel, it's one of the most profitable years to be writing puts ever. And eventually that will, of course, run out, but timing will be everything. So you got to put the evidence together, which is what we try to do here on the channel. So make sure to subscribe if you're interested in those things. Let's have a look here at the S&P 500 stocks are above the 200-day moving average. Nowhere near February, but certainly improving. Is this a double bottom on that? Interesting. Good breadth start to pick up. I'm liking that, of course, if you're a bull. Let's have a look over here, but not necessarily for tech, more for the other sectors. Percentage of stocks above 20-day average starting to improve as well. That's usually probably pretty positive sign. And finally, a red candle on the NASDAQ versus the Russell. Yeah, look at that. Finally. So is it the over for the NASDAQ? I would say based on multiples, NASDAQ will only have, a little bit left in it. Whereas if you're, of course, looking at bullish, it's probably now time to start to think about the rotational circus. That is, of course, if you're bullish across the board. It's only one read, but it makes sense. This is what happens. We tend to get runs. While there still may be some gains in the NASDAQ, overall, there are much cheaper sectors in the market. And if you're a full bull in this market, that's what you're looking at. Let's have a look now at treasuries, because, of course, everyone's freaking out about these, and they're all like, it's all over. Treasuries are going to burn. Well, historically, that didn't happen last time. Now, you might say, okay, well, T-bills, it's different this time. But actually, we saw a rise in T-bills coming into the debt ceiling component. And then it got crazy. Everyone wanted treasuries. We're still seeing pretty large asset purchasing. We're seeing huge negative bets being bet on it. That hasn't worked out in the past for a lot of people, going hugely negative on certain markets. And specifically, of course, if we've got too many people believing that it's a horrible problem, then it tends to often go the opposite way. So treasuries, I would say, have, if I'm talking middle term to maybe longer term, I still think T-bills are very interesting. While they could fall off initially in like some kind of freak out, similar to this type of thing, I still think that they've got a good tailwind here on them, and we'll look at those very, very soon. Let's have a look at the treasuries themselves. 100, of course, a notable number for treasuries. And then underneath that, if we got down here, you'll see I've got a little box down here. This level around 08, 09, 11, this would be incredible. This would be a very interesting zone. And I'm interested to see whether, if that could happen, I think investors would come in hard on T-bills. You got to put things in perspective. Take a look at T-bills and have a look at where they are. Are they cheap historically? Are they expensive historically? I'd say they're damn well valued. It's not that bad. And this is, of course, overpriced. This is still overpriced. But the reality is, up until here is very, very possible. Now, of course, proceed with your own risks and caution, all those types of things. But T-bills in general, they didn't perform poorly last time. I have no reason to believe they'll perform horribly this time. You have to back America in terms of financials. You cannot say that they're going bust first. I'm sorry, but I've got a question here for the chat. I'll put it in a poll. And I've always got this question. The reality is, people keep saying the US dollar is going to fail. Let's face it, the US dollar cannot fail before other currencies would fail first. And I think you just need to always remember that. And of course, also the strongest economy in the world can print more than anybody else. That's my belief. But anyway, there's a reason I like the US market. And a lot of that has to do with that underlying belief that the US can do whatever they feel like, at least for now. Let's move over to the copper. And copper was looking pretty good, and then it rejected. So still the supply holds. We'll have to find out whether copper does start to find strength again. That usually shows you're actually in some kind of recovery. We've been talking about demand destruction the entire time throughout, the last couple of months. It's been great for metal shorts. We saw metals come back a bit thanks to copper coming back up, plus also those strong jobs numbers. But if copper keeps declining, we can't deny the facts. Why is it declining? It's demand destruction, and copper tends to front load it. Where are the bulls excited about? Well, yeah, central bank liquidity. What the hell are these guys doing? It just keeps injecting. How can you go down when you keep getting injections of these bloody central bank liquidities all over the place? And it's across the board. You can see here versus the Qs. We're still very, very, very extended on the Qs, by the way. So that's why I think relative performance is going to be lower on the NASDAQ now moving forward with some of the signs we've seen. But central bank liquidity continues to get injected, even though they're tapering off the book. It's sometimes it seems ridiculous. What about bond index? Well, you can see here that the VIX versus the bond volatility is still around the 94th percentile in terms of spread. They're still concerned about it. US dollar has remained relatively strong as the market's going up. That's certainly a question mark, but it's most likely to do with the T-bills. So that's part of it. However, historically, when we've seen US dollar go up, the markets have started to wane. So as we hit 4,300, as we move towards these big resistances, it's something to keep in mind. VIX is also about to hit some extreme lows. So you can see here, this is